Hey everyone, welcome to the KE Report, a special Sunday daily editorial with our good friend Marc Chandler. Marc is the managing partner at Bannockburn Global ForEx, also editor of the Mark II Market website, where he breaks down key data points when it comes to economic data points, as well as different market moves, especially dealing with currency markets. Marc, one thing that I want to start with here is looking at the Atlanta Fed, their GDP forecast. It fluctuates throughout the quarter, but it usually does come fairly close to what the end result is. Now, again, we're not at the end of the first quarter, we're two-thirds of it through. But there was a big change that happened. The forecast was for over 2% growth in Q1, and that has most recently been dropped to negative 1.5% for Q1 GDP. This is a massive change, not just going from positive to negative, but seeing that large of a swing. Marc, take us through what changed in your eyes, this forecast number, and if the US could actually be looking at a negative number for Q1.
Yeah, what a shocker. I think that when we look at the recent data, one way to think about it is what really matters are surprises. And so various banks and even Bloomberg has a economic surprise model, which has been deteriorating for the United States. The Atlanta Fed hadn't updated their model for almost 10 days. And in those 10 days, we've seen some more weak economic data. Today was the kicker. Today, I'm sorry, Friday, the 28th, the kicker. Real spending, personal consumption, adjusted for inflation. The market was looking for a small loss, 0.1%. Instead, 0.5%. This matches the largest decline since February 2021. So today's news on the income and spending, especially the spending component, was the shocker. But we've seen a lot of weak economic data, and that's partly why the U.S. interest rates, have fallen. You think about earlier in February, we saw higher than expected headline core CPI and PPI, but the two-year yield peaked around then at about almost 4.4%, just shy of the January high. And as the week closes, the two-year yield is slipping below 4%, the first time since last October. And it's not just the short end, but the long end peaked almost the same time that the US dollar index peaked, middle of January, at almost 4.8%. Ahead of the weekend, breaking down, we're getting close to 4.2%, slipping below the 200-day moving average, first time since mid-December. So dropping US interest rates as the growth story, maybe it's not so much that the growth story has turned rather negative lately, though I would think that the data in the upcoming week may suggest that it's more of a scare at this point. And remember that the Atlanta Fed, that the data that it's using still is mostly January data. So it's still early in the quarter. Next week, next Friday, we'll get the US jobs data for February. That really kicks off the February data releases. So it's even though the calendar says we're about to begin the last month of the first quarter, the data that their model has is a bit older than that.
Well, Mark, is it possible that the reason we're seeing the rates coming down is because there actually has been a bid in bonds? I mean, there's an inverse correlation, so that means bonds are being bid up. There's some worries about how the tariffs play into this. There's some worries about U.S. equity markets. Couldn't it just be that people are going into the safe haven of bonds and that's what's driving the rates down?
It could be, but what I'm really focused on is the real shift that's taken place in in market expectations of Fed policy. And that, to me, the long end is an issue typically more of growth, and the short end is more typically Fed policy. And here's what's happened. The market now has the first, or I should say, the next Fed cut fully discounted for June. It has a second cut almost fully priced in at the September meeting. And it's moving closer to having three cuts priced in. And this is just ironic when you think about how quickly this adjustment's taken place. Back in the middle of the month, the market was only looking at 28 basis points cut this year. And so, yeah, I agree with you. There's a lot of factors that drive the rates. And part of it is trying to figure out what's the signal and what's the noise, what's really driving it. And I think that there's been this growth scare that's offset the inflation concerns, partly on the tariffs, partly on what people see as the coming job layoffs, and partly it's not even on what actually happens, but the signals. For example, if you're uncertain about US corporate taxes, you're uncertain about the economy with these tariffs because you don't know when they're going to be implemented and to what extent. And of course, we're looking at the possibility of the government shutdown in the middle of March. So just these kind of things have this big cooling off effect. And I think that's really the issue is that it's not just what actually happens, but it's the cooling off effect ahead of what actually happens.
Is this why we're seeing weakness in the markets broadly? Almost everything has pulled back market wise. Even the dollar was pulling back, but that started to rebound. It's actually had an okay week that last week. But overall, is this whole fear component about US economy slowdown, global slowdown because of potential tariffs and the tensions between countries, is this just what the market is telling us too? Investors are simply more fearful.
I think so. I think there's been a general risk off. I think that helps explain to Chad's point about the bond market rally. I think you also see this in the currency markets, that those currencies that tend to do best in a strong growth environment, like Australian dollar, New Zealand dollar, Swedish krona, the Norwegian krone, those have been among the weakest of the currencies.
Well, Mark, when you look at the world stage and global trade, tariffs, even though we're fatigued from, we have tariff fatigue, but people still want to know what's going to happen. And next week is supposedly when some of these tariffs start. There was the confusion this week from a lot of people because they were supposedly pushed back to April, but then brought back forward to March 4th. What do we actually know about tariffs and which sectors are going to be, which sectors are they going to be applied to?
Yeah, so I think you're right. There was some confusion about when the tariffs were, and I think that the White House corrected President Trump pretty quickly on that. Trump himself, on February 27th, reaffirmed that the tariffs were going to go into place on Mexico and Canada. That's a 25% tariff for the fentanyl and undocumented immigration. China has, he put it, like I mentioned, the only tariff he's really imposed is 10% on China, and he's going to impose another 10% next week on China. And it's kind of interesting that unlike past tariffs on China, his now include Hong Kong. I think that's what we can be the most confident of is that we've got this date, March 4th. What happens after that with the reciprocal tariffs, with the tariffs he's threatened on autos, copper, steel, aluminum, the semiconductor chips, the list actually keeps growing. He's added lumber to it recently and copper, but these are a little bit more uncertain. And I think that many people, I think that a real divide in the market is between those that think that these are just negotiating tactics versus those who think that Trump is authentic, that he truly believes in this worldview, that the U.S. traditional allies have been the most to take advantage of us. The trade deficit is proof that countries take advantage of us. Therefore, we have to act. And I think that many people think that these tariffs are just tactics versus a camp of people, which I find myself more sympathetic to, that think that there's something serious, profound taking place, a change in the world that we're not going to go. They're like when the toothpaste comes out of the tube, you can't put it back in.
Isn't that the big question, though? Is this going to truly make an impact long term? Are we going to see complete changes in supply chain, in where we get products from, and in how countries deal and relate with each other? Who knows? But it definitely feels like right now, if we keep going down that path, if Trump keeps going down that path, there are going to be some pretty major changes made to how the world functions, which is scary in many fronts. Mark, what's coming? What could, outside of obviously the tariffs, which boy, oh boy, we're going to get a lot of news on those next week. Does anything else matter in the world right now?
Well, I think that this the growth scare that we're having in the U.S. will be addressed next week. The highlight, of course, is going to be the jobs data at the end of the week. And so far in the market, the consensus, the median guess in a Bloomberg poll is for about 155,000 new jobs in non-farm payrolls. That's up a little bit from January. Slow, a little bit weaker than the recent pace, but still probably regarded as a strong, as a solid number. And we're all concerned about these government layoffs and the implications, and are these the right people to be let go and all that? But it looks like the government sector, but I should say the private sector, added about 138,000 jobs according to the median. That's up from 111,000 before. That still means that the government sector, and this includes, of course, not just the federal government, but local and state governments, added maybe 17,000 jobs according to the median forecast. That's on the U.S. side. We also should get stronger auto sales as people try to beat the tariffs. And what we really saw ahead of the weekend is a big jump in U.S. imports led to this record blowout of the goods trade. A lot of this looked like it went into wholesale inventories. Again, more evidence of people trying to beat these tariffs. We should also get ISM manufacturing and PMI manufacturing, and both of them are likely to hold above 50, suggesting that growth is still taking place, unlike the Atlanta Fed model. The other highlight of next week, on Monday, the Eurozone reports their CPI, and they're likely to see lower CPI, despite maybe a 0.4% rise in the month. The base effect warns that this could still lead to about a 0.2% decline in the year-over-year rate, which would be the first decline for the Eurozone CPI 5 months. And then at the end of the week, as I mentioned, you get the US jobs data. But before we get to that jobs data, we also get the ECB meeting on Thursday. And the ECB, I think the market feels very confident. ECB is going to cut rates 25 basis points. And the central bank, as they update their forecasts, will have forecasts that pave the ground for 2 and possibly 3 more cuts this year.
Mark, just as I listen to you go through the data and I think about the backdrop we're in, I'm curious as to whether you've seen another period like this in history where we have these expectation for rate cuts. At the same time, we're still not sure exactly what's happening with inflation. There's calls for growth to slow down globally, but then the manufacturing, like you say, seems to be doing okay, and it seemed like the real estate market isn't falling apart. Are we in some kind of a weird stagflationary period here? Or do you think that with the stocking of the cupboards and bringing all that inventory in, like we just saw in those reports, that means there's not going to be as much transactions in Q2 and Q3? What kind of an environment are we in your opinion?
Yeah, I think that transitions are always difficult. I think that I say that the businesses, and this is why I think that the lack of visibility, the visibility right now, is a cooling off effect. It paralyzes activity. And that's what I think is the key here. And in this kind of environment, what do you want to do? Where do you want to have your monetary policy setting? And I think it's more prudent to have a monetary policy setting close to neutral. And I don't think the Fed's there yet. I think from the Fed's point of view, they think that policy is still restrictive. They can debate about how restrictive it is. Powell has recently said it's still meaningfully restrictive. And remember, we're still doing the QT, which is the central bank is shrinking its balance sheet. And so my best guess is that the Federal Reserve will bring policy rates lower. I think that the biggest concern, I think, is going to be the economic slowdown, because we're going into that economic slowdown with debt stress measures, especially in the household, at high levels. And we saw, and that's why I think that today's the real personal consumption, why that's serious. Consumer is still the key driver of the economy. And between the uncertainty about the employment outlook, the tariffs, the taxes, what this means. We were going grocery shopping the other day, and the store had a limit on number of eggs you could buy. That's another way of distributing scarcity. Not only do higher prices, but also just limit the volume, right? And so I am concerned about the direction of the economy. I do think it's going to get resolved. I think that the Atlanta Fed, it might be exaggerating the weakness. As it gets more data, maybe next week's data, it can lift it back. But I do think the economy is slowing. I do think we typically, under these kind of conditions, I think we do head for recession, but I think not quite right away.
Boy, oh boy, I think a lot of people are still waiting for that recession to hit. And now, with all these other policies that could come into play, that's the real wild card here, because the Fed can analyze its policy right now, whether it's restrictive or not, but things change and things can change pretty quickly. 1 quarter out, and that could really change their outlook on where their policy stands. So, right now, it does look like there's a lot of signs of caution for investors and some worries creeping in more to investors' minds. Again, so much predicated on what these tariffs are going to do and how other countries are going to react. It's going to give us a lot to talk about throughout the next weeks, if not months, and throughout this year, and maybe even the whole presidential term of Trump. So, Mark, keep us up to date on what you're seeing out there. And everyone, click that link in the show notes to visit Mark's website, Mark2Market, to stay abreast of what Mark is following. Again, Marc Chandler, managing partner at Bannockburn Global Forex. Mark, thanks for your time today.
Thanks. Good luck to everybody.